Welcome back to Skytech-Lens. Hey everyone, Adam here. Beneath the loud political moves like tariffs, a quieter shift is happening that could alter America's economic power. Today, we connect the dots between Trump's tariffs, global backlash, and the US economy's foundation. Our ability to borrow cheaply. This isn't just about numbers, it's about the hidden engine of American prosperity, the US Treasury bond. Stick around, because this is a story you need to understand. America's true superpower isn't just its unmatched military might or the iconic symbols of strength we see on parade. It's something far less visible, yet even more influential in shaping the world order. It's our extraordinary ability to borrow, on a scale and at a cost that no other nation can match. The US can raise trillions in global markets, funding everything from infrastructure to innovation, simply by issuing debt. The US Treasury market is the global financial bedrock, a foundation that supports not just our economy, but the entire world's. This unique position allows us to finance deficits at remarkably low rates, keeping the wheels of government and business turning. But this system only works because the world trusts the US to honor its debts and maintain the dollar's stability. That trust is the invisible glue holding the system together, relied upon by investors, governments, and businesses everywhere. Yet, cracks are beginning to show. Foreign nations, once eager to hold our debt as a safe haven, are now growing cautious. Their confidence is wavering, and they're starting to look elsewhere. Recent policy shifts and political uncertainty have introduced new risks, sparking waves of foreign sell-offs of US Treasuries. These moves send ripples through global markets, raising questions about the future of America's financial dominance. This shift is like a massive oil tanker, slowly turning, barely noticeable at first, but with the potential to reshape the global economic landscape over time. The cost of borrowing for the US sets the benchmark for interest rates everywhere, from mortgages to business loans. When our borrowing costs rise, so do rates for everyone else. If the Treasury must pay more to attract lenders, it triggers a domino effect, making it more expensive for families to buy homes, for entrepreneurs to start businesses, and for companies to invest in growth. The debt engine that has powered America's prosperity is now under strain. Tariffs, trade tensions, and rising costs are all adding pressure, threatening to slow the engine that drives our economy. Understanding these powerful forces isn't just for economists. It's crucial for anyone planning to borrow, invest, or simply navigate the changing financial landscape. The interest rate on your next loan may depend on how America manages its debt superpower. Enter the tariffs, a bold move designed to shift the balance of global trade. The idea was simple: make foreign companies pay more to sell their goods in America, and in turn, protect US jobs and industries from overseas competition. Tariffs became a headline policy, aiming to revive American manufacturing and encourage consumers to buy domestic products. But the story didn't end there. These taxes on imports triggered a chain reaction in the world of finance, with consequences that reached far beyond factory floors. Suddenly, foreign nations began to rethink their investments in US government debt. Countries like China, already navigating economic uncertainty, faced new pressures from tariffs. Their response? Gradually reducing their purchases of US Treasuries, a move that sent ripples through global markets. Selling US debt became a subtle but powerful tool of retaliation, a way to express displeasure without escalating into a full-blown trade war. The unpredictability of tariffs introduced a new layer of political risk to US Treasuries, making investors nervous about the future. As major buyers stepped back, the US Treasury was forced to offer higher interest rates to attract new investors, raising the cost of borrowing for the government. This set off a feedback loop. Tariffs led to foreign selling, which pushed up US borrowing costs, and in turn, threatened to slow economic growth. Ironically, the very policy meant to strengthen the economy risked weakening its financial foundation, as higher rates rippled through markets and businesses. During the trade war, China's gradual reduction of US Treasuries wasn't just a financial maneuver, it was a strategic signal to Washington, showing that economic leverage cuts both ways. The tariff shock wasn't just about trade policy, it fundamentally reshaped global capital flows, redrawing the map of international finance and leaving lasting effects on economies around the world. As trust in U.S. policy wavered, central banks turned to gold, seeking a more stable and reliable store of value. Gold, a safe haven, became a strategic choice for countries like Russia, Turkey, and China, who were looking to diversify their reserves and reduce reliance on the U.S. dollar. This shift was a silent rebellion against the dollar-centric system, signaling a significant change in the global financial landscape. Gold is a tangible asset, free from U.S. control, unlike Treasury bonds, which are subject to U.S. monetary policy and political decisions. Central banks diversified away from the dollar, reducing demand for U.S. debt and seeking to protect their economies from potential U.S. financial instability. This move signals a desire for monetary independence and hedges against geopolitical risk, as nations aim to safeguard their financial sovereignty. Gold won't replace the dollar overnight, but it impacts interest rates at the margins, influencing global financial markets in subtle yet significant ways. The perception of risk has changed, with gold emerging as a hedge against political instability and economic uncertainty. Central banks' gold buying is redrawing the global financial map, creating a new paradigm in international finance. The U.S. Treasury is no longer the only safe port in a storm, as gold offers a secure alternative in turbulent times. Countries responded differently to U.S. tariffs, but all aimed to reduce dependence on the U.S. Canada. Shocked by tariffs, diversified investments to reduce U.S. exposure. China, targeted by tariffs, used its U.S. debt holdings as leverage, selling treasuries gradually. Brazil, caught in the crossfire, diversified reserves to stabilize its economy. Each country sought to build resilience against U.S. unpredictability. These actions weakened the U.S. Treasury market's pull. The collective result is a shift toward a multipolar financial world. The U.S. trade policy catalyzed a global financial rewiring. The world is hedging against American unpredictability. The financial system is slowly rewiring itself with profound implications. How do global financial shifts affect you? The ripple effects hit Main Street, especially the auto industry. Tariffs raised raw material costs, increasing car prices. Foreign nations buying less U.S. debt raises U.S. interest rates. Higher Treasury yields mean higher auto loan rates. A small increase in Treasury yield can significantly raise your loan's interest. This new cost of capital affects mortgages, credit cards, and business loans. The foundation of cheap credit is eroding, making life more expensive. The cost of financing a life in America is linked to global trust in the U.S. The financial turmoil makes the American dream more expensive. The global is personal, and the cost of capital is now a kitchen table issue. We've traced the path from trade policy to your car loan's interest rate. Tariffs intended to protect industry have strained America's financial superpower. Global players are diversifying away from U.S. debt, turning to gold. This isn't a crisis yet, but it's a warning sign of a shifting financial world. The road ahead is uncertain, with potential for higher borrowing costs and economic challenges. Thanks for watching. Subscribe the channel for more updates.